In 1979, for 3 days, the United States defaulted. Almost no one remembers it, but the event revealed a truth that would echo for decades. The world's richest nation can run out of money, not because it's poor, but because others stop lending. That year, a clerical delay at the Treasury caused missed payments on a few $100 million of bonds. The markets barely trembled. Yet deep inside the system, something cracked. The illusion of the risk-free U.S. debt, the backbone of global finance, showed its first fracture. Fast forward half a century. America owes the world more than $34 trillion. Every second that number grows. And still investors call it safe. Why? Because safety, it turns out, is not a fact. It's a belief. For decades, that belief has powered the world economy. Nations buy U.S. debt not out of generosity, but necessity. The dollar is the oxygen of trade, and treasuries are its lungs. Every government, every bank, every pension fund breathes through them. If they stop, the system suffocates. But belief is fragile. And somewhere between Beijing, Riyadh, and Washington, the quiet question has begun to form. What happens when they stop by? It wouldn't start with a crash. It would start with hesitation. Auctions failing, yields rising, whispers about alternative reserves. Then the shock wave. Interest rates would climb. Currencies would scramble for refuge. The invisible battery that powers the modern world, debt, would drain in real time. The paradox is brutal. The same debt that sustains the global economy could be the spark of its undoing. And every central bank knows it, because when trust in U.S. debt fades, it's not just America that falls. It's the entire scaffolding of global value, built since 1944 on a promise that the dollar never dies. The world has bet its future on that promise. The question now is, what if the promise breaks? If this opened another side of history for you, comment where you're watching from. To understand what it means when the world stops buying U.S. debt, we have to return to where the idea of global trust in the dollar was born. The year is 1944. Bretton Woods, New Hampshire. 44 allied nations meet to rewrite the rules of money. Gold is still the measure of value, but it's slow, heavy, and hard to move. The dollar becomes its proxy. Formally, $35 for an ounce of gold. Informally, the foundation of a new financial empire. From that moment, every dollar printed in Washington could become another country's reserve. Europe was rebuilding. Japan was reindustrializing. America was supplying the oxygen, liquidity. For the first time, the global economy functioned like one organism, but its heartbeat came from the U.S. Treasury. At first, it looked sustainable. American factories dominated world trade. Gold reserves at Fort Knox were unmatched. The dollar was as good as gold, literally. But beneath the surface lay a paradox. For the world to have enough dollars to trade, the United States had to export them through spending, loans, military aid, and imports. In other words, America had to live in deficit so that everyone else could live in surplus. The world's savings depended on America's debt. By the 1960s, this system had become self-reinforcing. Countries earning dollars through exports had no real alternative but to recycle them into U.S. government bonds, the only market deep, liquid, and safe enough to hold such vast sums. Thus was born what economists would later call the dollar loop. America issues debt, the world buys it, the same dollars return to fund new U.S. deficits. Money flowed in a circle, like water through a closed pipe, always moving but never leaving. The illusion was elegant. Every nation seemed to benefit, but the foundation rested on one fragile assumption, that the dollar's value, and America's promise to honor it, would never be questioned. Then came the stress test. By the late 1960s, foreign central banks, led by France, began demanding gold in exchange for their swelling dollar reserves. Charles de Gaulle's government openly accused Washington of exporting inflation, while others paid the price. U.S. gold reserves started to drain. Trust, the invisible currency of the system, began to leak. In 1971, President Richard Nixon made a decision that changed the architecture of global finance forever. He closed the gold window, ending the dollar's convertibility into gold. Overnight, money became an abstraction, backed not by metal, but by faith. The dollar survived, in fact it thrived, but the mechanism had changed. What once was gold-backed money became debt-backed money, and that meant growth itself now depended on someone, somewhere, buying U.S. debt. The 1970s were a crucible. Oil prices exploded, inflation raged. Yet even in crisis, the dollar maintained its central role, because oil was priced in dollars and petrodollars soon flowed back into U.S. bonds. This was no coincidence. Washington and Riyadh had struck a silent bargain. Oil for security, dollars for loyalty. The world needed energy, energy needed dollars. The circle closed again. From that point on, global stability was measured not in tons of gold, but in the appetite for U.S. Treasuries. Every Asian export boom, every European recovery, every oil windfall, all ended in the same place, the American bond market. The entire system began to depend on a single question. How long would the rest of the world keep buying? Because the moment they hesitate, the machine that powers everything, trade, credit, retirement funds, even wars, begins to tremble. The United States became not just the issuer of the world's currency, but the borrower of last resort. It was a privilege and a trap. If this opened another side of history for you, comment where you're watching from. By the late 1980s, the system had matured and aged. Debt was no longer an instrument of policy, it had become the bloodstream of the global economy. But the more dollars the world held, the less real value they represented. A quiet imbalance had turned structural. The United States could borrow endlessly because everyone else needed a place to store their savings. Japan in the 1980s, China in the 2000s, oil producers throughout, they all poured their trade surpluses into U.S. Treasuries. Each believed the same thing. America's debt was the safest asset on earth. But the paradox deepened. The more the world bought U.S. debt, the more America could afford to spend. And the more it spent, the more debt it had to issue. It was a perfect feedback loop, until trust itself became the only collateral. In 2008, that trust faced its most serious test since Bretton Woods. The global financial crisis did not begin with the dollar, but it ended there. Mortgage bonds collapsed, banks imploded, and yet capital fled to U.S. Treasuries. Fear itself strengthened the dollar. For a brief moment, the world saw a strange truth. The deeper the American crisis, the more the world depended on America to survive it. It was like a patient whose heartbeat spikes precisely because the heart is failing. This was the real problem. The world had no alternative. Europe tried with the euro, China experimented with the yuan, the IMF floated ideas of special drawing rights, but none had the depth, the trust, or the liquidity to replace the dollar. So the United States continued to borrow, and the rest of the world continued to buy, not out of confidence, but out of fear. Then came a new chapter, quantitative easing. When the Federal Reserve began printing money to buy its own government's debt, the circle became fully self-referential. America was now lending to itself. The buyer of last resort had become the only buyer that mattered. Foreign central banks still purchased treasuries, but with less enthusiasm. China slowed its accumulation. Russia began selling. Even Japan started diversifying. The invisible signal was clear. The trust reservoir was draining. And yet the surface looked calm. Markets rose, interest rates stayed low, politicians spoke of sustainability. But under the calm was a fragile arithmetic. Debt grew faster than GDP, faster than tax revenue, faster than productivity itself. The world's reserve currency was now backed by the expectation that tomorrow's debt would always find tomorrow's buyers. That assumption worked, until it didn't. In 2020, the pandemic turned fiscal expansion into a flood. The U.S. government spent more in 1 year than it had in entire decades of war. The Federal Reserve's balance sheet exploded from $4 trillion to nearly $9 trillion. For the first time, serious investors began to ask a forbidden question. What if demand for U.S. debt one day simply stops? Imagine the chain reaction. Treasury auctions fail to attract enough buyers, yields spike, the dollar strengthens, but only briefly as panic sets in. Stock markets tremble, commodities fall, and global trade freezes. Because treasuries are not just American assets, they are the world's collateral. If their price collapses, the value of everything else follows. It wouldn't take war or sanctions, just a shift in collective psychology. If enough major holders, say China, Japan, or oil exporting nations, decide to slow purchases, the ripple would become a wave. Interest payments would consume an ever-growing share of the U.S. budget. In 2024, it already exceeded defense spending, a number that would have been unthinkable 30 years ago. Debt would no longer be a tool. It would become the weight pulling the empire down. Some historians might call it poetic symmetry. Rome taxed its provinces, America borrowed from its partners. Both built empires of obligation. Both reached the same point. When the flow reversed, the empire began to shrink. And now the pattern is repeating, quietly, invisibly, under the metrics of modern finance. The U.S. still issues debt at record pace, yet the share held by foreign buyers is falling. In 2010, they owned nearly half of all treasuries. Today, closer to a quarter. The gap is filled by the Federal Reserve, the very institution meant to guard the currency's value. It is like a mirror buying its own reflection. Here lies the true event, not a single crisis, but a gradual unmooring. A system that once relied on foreign trust now relies on domestic illusion. The debt keeps growing, but the buyers are disappearing. And when belief becomes the only asset, the moment disbelief arrives, everything changes at once. If this revealed another hidden side of our economic reality, tell me where you're watching from. To understand how the entire world became dependent on U.S. debt, we need to look at the machinery behind it, a system so vast and mechanical that most people never notice it working. It begins with a simple transaction. The U.S. Treasury borrows, the world saves. Every month, the Treasury auctions new securities, bills, notes, and bonds. Investors, banks, pension funds, and central banks compete to buy them. The more demand, the lower the interest rate. And as long as everyone believes those bonds are safe, the circle turns smoothly. Debt becomes money, because in today's world, treasuries are not just promises, they are assets, traded, lent, and rehypothecated billions of times over. A Japanese pension fund buys a 10-year treasury. It then uses that bond as collateral to borrow dollars in the global repo market. Those dollars are used by another bank to finance trade or buy commodities. That money ends up in another country's reserves and again is reinvested in treasuries. The circle tightens. U.S. debt is no longer just America's liability. It is the foundation of global credit. The mechanism looks clean on paper, but its logic hides a paradox. The more the world uses treasuries as collateral, the more it depends on their constant creation. If the U.S. ever stopped borrowing, the global system would seize up like an engine without oil. And so, paradoxically, fiscal discipline, the virtue of balanced budgets, would actually break the machine. Some economists call this the exorbitant duty, the cost of maintaining the privilege. To keep the world supplied with safe assets, America must keep issuing debt. It is both the world's central bank and its largest debtor. The system feeds on expansion. The Federal Reserve plays its own invisible part. When the Treasury issues bonds, the Fed often buys them from banks, injecting fresh dollars into the financial system. Those dollars lower interest rates and raise asset prices, which in turn increase demand for more bonds. The process repeats. It's not just monetary policy. It's a loop of belief and liquidity, a choreography of debt disguised as stability. Then comes the role of foreign official buyers, mostly central banks from Asia and the Middle East. They buy treasuries not for profit, but for defense. Owning U.S. debt means owning protection against currency volatility. It also buys political leverage, access to American markets, influence over Washington, sometimes even silence in times of conflict. Debt, in this sense, is diplomacy, written in numbers. But this diplomacy has a fragile core, because every buyer has a threshold, a point where faith meets arithmetic. When yields rise too fast, the value of existing bonds falls. When the dollar weakens, the real return vanishes. And when inflation erodes purchasing power, even safe assets start to look dangerous. In 2023 and 2024, that mechanism began to creak audibly. The Treasury flooded the market with new bonds to cover record deficits, but foreign participation declined. Domestic funds absorbed what they could, the Fed hesitated, and interest rates surged to levels unseen in decades. The feedback loop began to reverse. Higher debt led to higher rates, which led to higher interest costs, which demanded even more debt. It was a slow-motion spiral. And now imagine, what if this process continues just a little further? Each auction slightly weaker, each yield slightly higher, each headline whispering waning demand. At some point, it's no longer a question of default, but of trust capacity, the market's willingness to believe in tomorrow's buyer. This is the invisible architecture of power: debt as currency, confidence as collateral, perpetual motion financed by tomorrow's promise. And once that promise is questioned, even slightly, the most sophisticated machine in history begins to sound hollow. Because in the end, the mechanism is simple. The world lends to America because it believes America will always pay. The day that belief fades, the system doesn't explode, it unwinds, quietly, relentlessly, like gravity reclaiming what it's owed. If this helped you see how the system really works, tell me where you're watching from. When the mechanism weakens, the consequences unfold quietly at first. Numbers shift before headlines catch up. The Treasury issues more bonds, fewer buyers appear, yields rise, interest costs swell. And suddenly the United States finds itself paying more to borrow the same dollar it once printed effortlessly. This isn't a collapse, it's erosion. A trillion here, a trillion there. In 2000, annual interest payments on the national. And unlike military losses or recessions, this war leaves no ruins, only spreadsheets. The first visible crack appears in politics. Debt becomes ideology. One party calls it investment, the other calls it irresponsibility. But neither can stop it, because stopping means contraction, and contraction means pain. The modern economy doesn't just use debt, it requires it. Without constant borrowing, GDP slows, credit dries, asset prices fall. Every correction feels like betrayal. Every stimulus feels like survival. Abroad, the effects multiply. Countries holding trillions in treasuries face a brutal choice: keep buying and lose yield, or sell and crash the value of their own reserves. China reduces its holdings gradually. Saudi Arabia experiments with selling oil in other currencies. Japan quietly balances between loyalty and necessity. Each small move signals a larger pattern: diversification away from dependence. Meanwhile, new blocs emerge. The BRICS nations talk of a shared settlement currency. Russia and China trade in yuan. India experiments with rupee-denominated oil contracts. It's not yet a revolution, but it's a rehearsal. Inside the financial system, stress builds invisibly. Banks use treasuries as collateral. When their price falls, the value of that collateral shrinks. Leverage tightens. Liquidity vanishes. In 2023, regional U.S. banks failed not because of bad loans, but because their safe treasury holdings lost value when yields spiked. The irony was perfect. The instrument designed to stabilize the system became the source of instability. Then comes inflation, the political accelerant. As debt grows and confidence slips, the temptation to inflate it away becomes irresistible. Printing money is painless at first. It makes the debt seem lighter, wages appear larger, assets rise. But underneath, purchasing power melts, trust erodes. And for the ordinary citizen, the system that once promised security turns into a treadmill. faster motion, less progress. When foreign buyers fade, domestic buyers step in. Pension funds, banks, the central bank itself. But their capacity is finite. Sooner or later, the market demands a premium, higher rates for higher risk. That's when the debt curve flips from manageable to mathematical. At a certain point, interest grows faster than the economy that must service it. History calls that moment the debt trap. Rome faced it through taxation, Spain through silver, Britain through empire. America faces it through inflation, the modern form of silent default. No one announces it, but everyone feels it. Savings lose value, bonds yield less than prices rise, and what was once the safest asset in the world becomes a slow-motion exit ramp from stability. The global impact would be just as severe. Financial systems built on U.S. bonds would scramble for alternatives. Trade finance, derivatives, insurance all rely on Treasury prices as reference points. If that benchmark falters, no one knows what risk-free means anymore. Credit becomes more expensive everywhere. Emerging markets collapse first, developed ones follow. The shock would not resemble 2008. It would resemble a long, drawn-out fatigue of capital itself. And yet, paradoxically, this scenario is both avoidable and inevitable. Avoidable because fiscal discipline could